Well, good morning, Bob.
Good morning, Bill.
This is FNC's Morning View, and we're talking, this is Thanksgiving week, and a lot of lenders have a lot to be thankful for. With all this refinancing, volume is way above expectations, forecast. People are making money.
Isn't that great?
And we've got an election behind us.
Right. But you know, the real critical issue is whether or not the Twinkies are going to survive.
Well, do you eat Twinkies?
I don't eat Twinkies.
I used to. I used to have Twinkies. I love Twinkies. I could take them down in one bite.
I know. They're just wonderful. And the question is, are they going to survive?
And that's the way we're talking about some of this refinancing. You think it'll last?
Well, I think it will. You know, the Fed has been trying to keep interest rates down and successfully keep interest rates down to try and, you know, shore up the economy. And it's been very effective for two reasons. One, they've actually been keeping their rates that they charge banks down low, but also the big issue is that the bonds have been really low.
They have been.
And the demand for U.S. bonds has just been huge. We have 1.57% interest rate on a 10-year right now.
Phenomenal.
That's unbelievable, and that's resulted in a mortgage rate.
Last week they hit a new low.
New low, 3.52 for a 30-year, 20% down, about 0.4 of a point.
But they still have more to go. I mean, there's still a nice margin.
There is.
Over the
banks
10-year.
are doing very well. And Bernanke came out last week and said, well, the problem is that the banks are being a little bit too restrictive on their credit.
On their underwriting.
Yes.
And so, well, think about it. If you've been too liberal, too open, now you're going to move the pendulum the other way. It's just a natural thing.
Right. Can't move it just
Because-
far enough.
because
It's going to
when
go too far.
If you're originating, we're never in equilibrium like you economists think we are. Never. I know that was a side swipe at finance, but that's okay. Basically, what happens is we found out that a sale, because we originated to sell, and we found out that a sale in the secondary market was not really a sale. It was like a temporary sale.
Right.
We had putbacks. And so now, to avoid the putbacks, we're giving everything the fine-tooth comb treatment.
Oh, man. Well, the bank, I mean, they did a survey of why banks aren't lending more. And one of the number one reasons is that their fear of putbacks, primarily from the GSEs. So, yes, they're doing...
I put my hand on the stove and got burned, and now I'm going to take it back.
Right, and very careful about getting it close to the
Exactly.
stove again. Yeah, and you know, we're seeing that in the correspondent lending and the secondary market players that are opening up their condos.
Trust is like gone.
Oh, and so what they're doing is they're taking those deals that these correspondent lenders are producing, ones that they used to just bless and let them pass on through, and now they're going over them in detail.
Delegated underwriting is a concept, not a reality today.
It certainly isn't a reality in the clients that we're seeing. They're doing very detailed reviews of all those.
They may say they have delegated underwriting, but the truth of the matter is they do a complete re-underwrite at the purchasing lender.
Right, and a lot of the...
And what do you think that is?
Well, it's exactly the same reason. They don't want to get burned again.
No
They don't
trust.
want to have to have those things come back.
Your underwriting is obviously not as good as my underwriting, so I'm going to check behind all your people.
Right. You know, but we keep seeing the market improving. The prices are continuing to climb across the country, and the number of housing prices and serious defaults keep going down. Although, even though we've seen serious defaults significantly improve in non-judicial states, in some of the judicial states, they're actually increasing.
Well, if housing prices had kept going up instead of coming down, if they'd kept going up, would we have had this mess? In other words, would we have had the losses? So you could have foreclosed, sold the house, and been made whole.
Right. So all we need to solve this is for prices to never go down.
Exactly.
And then we'll be in good shape. And so, but that was the assumption before.
That's half of a free market, okay? That's half of a free market.
Right. You know, it's the other half that's coming.
Exactly.
Yeah. But you know, in the...
Why do you think people thought prices would always go up?
Well, I think people have short memories.
And they went up since the 30s. Every year,
Well,
until 2007.
Not in all states.
Not in all states, but on average.
And we saw some, you know, with the problems we had with the credit unions, and the savings and loans. There were some big downturns there for a
That was
while.
primarily acquisition and development loans, though. But in terms of owner-occupied 1 to 4 family, they essentially went up since the 30s.
Yeah, I mean, on average, they've gone up and they've done very well. But we sure have had a reset in expectations.
You mean they can go down?
They certainly have. But in looking at the number of serious delinquent loans, some of them, there have been some major improvements in some areas. California has gone from 12% down to 6%.
So cut it in half.
Nevada's 19 to 12. Arizona's gone from 13 to 5.
That's all good.
And Florida is
Still,
from 22 to 17.
abnormally high.
Oh yeah, they're very high. I mean, when you think that Florida has gone down 5 percentage points.
From 22 to 17?
Yeah.
But
That's
still,
great,
it's
except
still
the
outrageous.
17 is huge.
Historically, it's for your prime borrowers, 3 to 4% delinquent with 1% foreclosure.
Right. In New Jersey and New York, it's going the other way. Number of serious delinquencies has climbed a couple of percentage points in both states from their top, from their max.
And that's probably because of the layoffs in the financial sector.
Could be. It could be heavily driven by that. So
Let's go back to underwriting. In addition to re-underwriting at every leg as the mortgage is sold, we have a greater volume of items that are considered during the underwriting process. There's a lot more disclosure, there are more requirements, and so it's a twofold issue in terms of underwriting and really cranking down the screws, if you will, on not letting things through, being conservative in terms of the underwriting.
right, and a lot of the new regulations that are proposed to come out have not been formulated yet. So I think that lenders are trying to get their scope around all the different changes that they're going to need to embrace with all of the different forms. Not, like you said, not just collateral, but all of the documents in the loan file.
Well, look, you've got two major issues in a loan from an underwriting standpoint. You've got the credit issues and you've got the collateral, but if we step back, you've got compliance issues, and some of those are black and white. You either made the disclosure or you didn't. It was either appropriate or it was not, and that sort of thing. There are some gray areas in terms of compliance. Did you disclose things appropriately and in a timely manner?
Right.
Most of that's black and white, but some involve judgment, a gray area. If we step back to safety and soundness issues, should I have made you that loan? There are some judgmental things. And in today's world, while you, in the past, may have given the borrower, or the applicant really, the benefit of the doubt, that's not the case today.
No, it isn't, and and the lenders are entering all of this with a lot of uncertainty. And that's one reason they're being so conservative, is that they just don't really know what standards they're going to be held to as they go forward.
Well, in finance, we teach that there's a positive risk-return trade-off, and you just said there's more uncertainty, so there should be more return. Our clients are telling us they're making more now per mortgage than they ever have.
They absolutely have. And we're seeing that across the industry. So that's all great for the lenders.
Well, as they have more uncertainty, they're making more risk. Uncertainty is risk. They're making more return.
Yeah.
So that old maxim in finance is holding.
Yeah.
Unlike the pure equilibrium in economics.
Well.
See that coming.
I think that the regulators too are really uncertain about where to go with a lot of this. We've had, just in the last few weeks, we've had the Federal Reserve calling us, wanting to ask questions about how appraisers are getting information and how appraisers are doing business and how they're selected and all of that. They're talking to us about how appraisal processes work and how the data is coming in and who has access to that data.
There's a lot of focus on process.
It really is. They're trying to understand that in order to build these regulations.
Absolutely. Well, it's about time to put the turkey in the oven. This is...
Who are you calling a turkey?
I'm talking about the Thanksgiving turkey. Economist. All right, so it's time to put the turkey in the oven. We hope you all have a happy Thanksgiving. I'm Bill Rayburn with Bob Dorsey. This is FNC's Morning View. Have a happy week.